So speaking of these VIX calls that we entered, and we entered the 18 on the 7th we looked at the closing prices, of course. So on the closing prices on February 7th, we looked at the 0.3 delta. That's what our range was. And we'll look at that in just a moment. But we saw that there was a very high open interest. Let's go ahead and take a look at the historical chain for the VIX. This is going to relate to Edward's question. We're going to get to that in just one moment. But what we would have done here is we went back, and that was on February 7th. So I'm going to go to the option chain, and we're just going to look at calls only, of course. And on February 7th, we looked at the 19th. And one of the reasons that we looked at the 19th is we went to our 0.3-ish delta. Okay, so here's my delta column here. And we were seeing some weakness in the market. I think there might have even been a sell warning at that point. Why that's important, it'll relate to the question in hand in just a moment. But the VIX 18 strike had a 0.299 delta. But these big numbers here is the open interest and the option volume. Look at these numbers for the 19th of expiration. They expire on Wednesday, of course. But you had 175,000 open interest at the 17 strike, 191,000 at the 18 strike, 203,000, 166,000 at the 20 strike. And so there was a high number. Now, these could have been spreads. These could have been a big bet on a bear call credit spread that the VIX would stay below 18. You've got 50,000 open interest down here at the 16 strike. This, remember, was on the historical date of February 7th. Now, why that was interesting to me is we went out to the 26th. Those same strikes, 18, 19, and 20, open interest of 299. Volume of 84, 583 and 434, 222 and 767. Ernie and I saw this in January, and we looked at it and just the options that were 3 weeks out on time, because normally I go 40 to 45 days out on time when I'm looking to buy these VIX calls in this fashion. But the numbers were just so powerful, the interest in these options. Long story short, the January had a same cycle where the end of January options, same time frame, around the 21st or so, had a very, very high open interest. 10 times, 20 times, almost 100 times the number of the other option series around it. So Ernie and I both bought calls in the VIX for that expiration. We both made money on those. This isn't, for me, really a play to make money. It's a play to hedge the margin portion of my portfolio. The 15% of my portfolio I'm trading with credit spreads, mostly bull puts, but then changing occasionally to bear put debits on the vertical side, or the calendar spread, diagonal calendar spreads, poor man's covered calls, quote unquote, that I use with higher price stocks that I can't afford to do a married put on. But yeah, and this time it didn't work out. But that's what we typically look for. Not only were we surprised by this very high open interest, but in general, we want to go the farther time frame out. We want to look for a delta of 0.3 or more out of the money, and I want to pay about $1. And this was right between, actually, at the time we saw in the portfolio, when we were looking at it, yeah, it was 103 for the February 18 strike and 85 cents. And as I mentioned, neither one of them really panned out. Now to Edward's question. When he saw the market sentiment tool go the negative, the market sentiment tool is our indicators of 13 broad-based market indicators, put call volume ratio across optionable stocks, SPX days, number of stocks above the SMA 20, percentage of stocks seeing a new 52-week high and low, the trend on the EMA 10, not the straight trend, but the EMA 10-day of the trend, number of days over the SMA 20, 100 for SMA, and the percentage gap above the SMA, and so forth. After testing about 50 to 60 different indicators, Ernie found that these 13 gave the best pre-indication of a market movement. Now, you have bearish and bullish fences. How are these set? Well, it's based sort of on a histogram. What this distribution histogram is showing you is over the entire period of our history that we have back to 2015, and actually it's a little bit further than that. What you're seeing here in the distribution is every time the put call volume ratio hit one of these levels. So what you're able to do when you analyze this view is you're able to say, okay, well, looking at here, it's bearish when it's below 0.6. Why is it bearish when it goes below 0.6? Because very infrequently over the last 10 years or so, does it continue down and stay in that range. And it goes to a bullish indicator when it hits about 0.99, because very infrequently does it go higher than that and stay at those levels for a pronounced time. It wants to revert back. This wants to revert back. It wants to go back. It's not going to stay down in this range. It's not consistently going to go down to this range, though that has happened. So the idea is with these fences, it says, okay, we just crept into a bearish sell warning on the put call volume ratio, in addition to 3 others. So now we have 4 bearish indicators, 9 hanging out in neutral, and none are bullish. So it's triggering a sell warning. And when this goes up to about 6 to 7 to 0, it's going to go to a strong bearish sell warning that we haven't seen in a while. So Ed asks, when I saw the market sentiment go into the negative, start hitting the sell warnings. Let's take a look at the history of when that started. It's about 3 days. No, it was just yesterday, but we saw some other ones back on 123 and 122. And I think we saw we saw the light buys here. Then the market got extended. Yeah, but that time period, as I mentioned, for the VIX, around this time period, that 122, 123 expiration is where the open interest was extraordinarily high. No, maybe it was actually the 28th and the 29th. I can't remember. I'll have to look that up in my notes. My apologies. So he says, I bought 10 30 delta calls on the VIX about 50 days out. Was I too early by not waiting for 2 negative days? Well, not necessarily, because this turned last night. And, yesterday we were in a little bit of hesitation. We've seen some different pullbacks, haven't we? So we were at here. We started to creep back up. We went back up just on the SPX to 6144. And then we saw the sell warnings and we saw the pullback today. First comment on that, Edward, is it's never too early to have protection. You paid $120. That's about the price I would look for, maybe a little bit lower. But you're following the rules that I stated. The idea is I'm not expecting it to go 2 days in a row, 3 days in a row bearish. There's always fight, bull and bear. There's always going to be some days where you pop back up, Edward, and we're going to pop back down. But again, VIX is high today. That is one of the tricks. So even though you're buying the right you're buying the right calls, in my opinion, for VIX. Let's go to the chain here. Let's go 50 days out. Yeah, 54 days out. Let's say April 16th. And our delta of 0.3, I'm sorry, I just want calls only. My apologies, folks. All right. So the calls only, I'm going to go a little bit deeper. Bear with me on this. So you're targeting somewhere around the 26 strike. Oh, no, you said 120. Yeah, so you probably did the 27 strike here at 0.282. The VIX at 26, 129 would have been fine as well, following the rules. Next week, there might be a pullback. You might see your calls go down to 80 cents, 75 cents. Not a pullback, I'm sorry. You might see a recovery. Lack of a better term, Edward, I apologize. You might see a recovery, a pushback, depending on what news comes out over the weekend. The reason why I go 45, 55 days out in time, 60 days out in time, is because you know how the VIX reacts. It's going to react to news. You don't know necessarily when that's going to happen. You don't know when this spike is going to happen. You don't know when this spike's going to happen. This was a good spike today. It's at a high, but we've seen it go right to where your strike prices were. Now, this is a 3-month chart, so that time frame I'm highlighting here, that was back on December 16th, 17th, and 18th, okay? So we had some economic news coming out there. We had some other features going on. The 23rd and 27th, 23rd, 24th, 25th, in that time frame was another spike, and then we see the other spike today. Now, depending on what happens over the weekend, Edward, we don't know. What news is going to come out, I'm not sure. Usually I wait till early in the week, but I think what you did is fine. So what we're looking for here is that even though you were at the higher range and someone, you look at this as a standard, probably technical chart reader, for example. If you're a technical chart reader, you look at this and say, look, every time it breaches here, it comes back to this norm. You've got your support and resistance lines. I mean, reality, it's, I wouldn't expect it to go above 20, and I'm not expecting it to drop below probably 15 or 1450 anytime soon. And hey, we just had a MACD gap up, so that means that this is going to continue to move up. You can't track the VIX like that. It's not like any other security. It doesn't follow those technical trends. It's based on, the 3-month out futures for volatility measures, fear gauge in the market. So we could go right back down to 16 or 15 by Wednesday or Tuesday of next week. Don't worry about that, Edward. That's fine. You still got 51, 50 days left to go. You're waiting for the next news that comes out, the next economic thing that comes out that the market wasn't planning on. Uncertainty in the market, tariffs, trade wars, anything along those lines, global conflicts, fear of global conflicts increasing, anything along those lines, the market doesn't want to see. What does the market want in general? Nice, normal, stable, everything is as going. Some companies are reporting good earnings. Some companies are reporting okay earnings. Everything's trotting along as it should. The VIX will go back down to 14, maybe even 13, maybe even 12. Remember, just a few years ago, back in 2021, we were hanging around at 10 and 9. It was a melt-up market. All right? Now the new norm is probably around 14 or 13. You're not seeing it right now, but over the last year, it's been around 14 or 13. Why I mentioned that because in the old days, my plan was when the VIX dropped below 12, when it reached around 11, and I saw the sell warnings appear, that worked out for me almost every time. For Ernie recently, it's been around 1350. When he gets into VIX calls and either he sees a sell warning or he has a hunch that something is going to change, or he sees that those economic news are coming out, inflation reports, retail sales reports, any judge of the economy that's going to affect what the Fed might or might not do. We've already assumed they're going to not do any rate cuts within the next 2 or 3 meetings, possibly, of 2025. So that's already priced in a sense. So, but if other news starts coming out and other inflation reports start coming out that are more favorable, well, that'll change the play. But I like where this is at. Paid 120, it's a good price. Bought 10 contracts. It's a good size. I usually buy about 6 to 8, sometimes 10, but usually around 8, honestly. You're following the rules that I suggested, so I can't say it's a bad idea. My fear, your second part of your comment, I'm sorry, was I too early by not waiting for 2 negative days? No, I don't think so, because if you have a second negative day, this could push the VIX up to here. You could see some small profit on those positions already, and you might want to take it off on a fourth or a fifth of those positions. Take some of the profit off 2 or 3. The reason why I say that is that this January spike is what I was talking about here. I think it's here. Let me take a look, Edward. I'm sorry, let me erase the drawings here, but let's see here. It was earlier in January, so we just hit December here, and we get to January here. Yeah, so I think it was, it was that spike. This time frame was the spike that Ernie and I were looking for later in the month of January, and we analyzed it around here, end of December. I think it was the 21st or 22nd when I saw those huge open interest numbers. So what I actually did here, and it wasn't the big spike, but what I did at this time, and I think I had, similar to you, I had the 19 strikes. You just commented that you have the 25 calls. Okay, that's fine. If it goes up to 22, you're still going to see an increase in those prices. Don't worry. But what I did here, when it moved up on that first spike, I sold half. Why? I had 8 contracts. I sold half. Why? Because you see it here. The event happens, and within a day or two, you're right back down to the norm. The event happens. A day or two, you're right back down to the norm. The event happens. 3 or 4 days later, you're right back to the norm. So we'll see what happens Monday, Edward, and we'll keep in touch with you about this track. But even if you don't see a movement tomorrow, or you don't see a movement next week that pushes it back up and you start seeing profit on these positions, it didn't matter to me. Excuse me, when these were at 50, if these were at 100% profit, were these at 50? No, they hit a profit. I sold half. So I only had 4 calls left. And then I was able to sell the other half here, and I got out of the other half here. So we had 4, then we had 2, then I sold the last 2. I didn't sell 1, I sold the last 2 here. as it was pulling back down, but it was still elevated. And the expiration was around this time period anyway. But when we see these jumps, that's why I mentioned that I usually close half the day of the first spike. And you don't always catch it because normally it goes up and then it'll come back down and then it might continue to go up later in the day. The fact that this one closed pretty high, let me clear that out for you. Normally what you see, you'll see it here. So here's the spike, but look at the close. It came back down here. Here's the spike, but look, it closed back down here as everyone digested the movement. This one was an interesting one that stayed up high, came back down, but then re-spiked again the next day. But normally that's what you see. You get the spikes. You're getting the build up here, true. But you get the spikes, but then the close is back down here. This one is more like not as extreme, but this one's more like this. It went up, it elevated, and it stayed here throughout the day. It didn't close at a lower range that it opened below the spike. So that's something to look out for. That's something positive, I think, for your position for the beginning of next week. We'll have to see how that plays out. But what if it doesn't play out? That's okay. It comes back down here. It drifts back down to 15. You know your cost basis, 120. You know your strike. You know the contract size you bought. And you still have 50 days. Something's going to happen. Earnings are still coming through. So the VIX calls may still come out. But when you see the spike that you want and you see your options go up maybe 50, 60%, maybe even only 40 or 50%, you might want to consider closing part of them, taking that profit off part of that position at that time. Because historically what you see is a day or two later, 3 days later, you're back down to the norm. Big little bit of a grow up here and a spike, 3 days later, back down to the norm. A little bit of a spike here, 3 days later, back down norm, a little bit of other spike, 3 days later, back down to the norm.